Hello students, welcome to today's class. Our topic for today is insurance. In this class, we'll be looking at definition of insurance, importance of insurance to business and to individuals. We'll be looking at insurable and non-insurable risks. Lastly, we'll be looking at basic principles in insurance. Now let's start by defining insurance. Insurance is a contract in which one party undertakes to indemnify another party against loss, damages, or liabilities arising from unknown events. Insurance is a system of providing financial compensation for the effect of loss, the payment being made from accumulated contribution of all parties involved in the scheme. Insurance is another form of commerce. It is based on the principle of pooling of risks. The insured, that is, the person insuring his life or property, contributes funds called premium to the insurance, that is, the party or the company who indemnify or compensates the insured. The accumulated premium is then used to compensate the insured when the need arises. Indemnity means compensation. That is, when there is an unforeseen event or eventuality, like accident, the insurer, that is the insurance company, will compensate or indemnify the insured who suffers the loss. Importance of insurance. Insurance has various importance, which includes 1. It helps in motivating workers. If workers are aware that they are insured against loss, it motivates and encourages them to work better. 2. Insurance facilitates international trade. Goods transported via the sea or air are insured against loss. It thereby facilitates international trade. Next is insurance encourages investment. Since investors know that if they insure their investment, they are covered against risks. This encourages investors to invest in a particular enterprise. Next we have is insurance ensures security of goods. Next, insurance serves as an employment opportunity. Insurance is a big industry. It employs large number of people, thereby it serves as an employment opportunity. Next is it leads to risk reduction. Next is insurance provides a means of savings. And lastly, it serves as collateral security against risks of loss. Let's move on to insurable and non-insurable risks. The first one is non-insurable risks. Non-insurable risks are risks whereby the insured cannot take cover for, because the likely future losses cannot be calculated or estimated. For example, loss of profit, risks due to war, poor location of business, natural disasters, etc. Next is insurable risks. An insurable risk is a risk that meets the ideal criteria for efficient insurance. The concept of insurable risks underlines nearly all insurance decisions. In other words, the risks cannot be catastrophic or so large that the insurer could hope to pay for the loss. For example, theft, burglary, motor accident, etc. Now let's look at the basic principles of insurance. The first we have is insurable interest. This principle states that a person can insure properties that will bring loss to himself alone and not to another person. E.g., a person cannot insure the building of his neighbor. A person cannot insure the vehicle of his neighbor, but a person can insure his own building, can insure his own vehicle, can insure his own life, etc. So it means that the insured or the person being insured must have interest in the property being insured. The next is contribution. This principle states that in a situation where a person has insured his property in more than one insurance company, he cannot claim compensation from all the insurance companies. That is, if he has been settled by one of the insurance companies, he is not entitled to receive compensation from other insurance companies. Next is proximate cause. The principle of proximate cause states that there must be a close connection between the loss actually suffered and the risks for which insurance has been taken out. Example is, if Mr. Ayo insures his house against fire accidents, but the house collapses, the insurance company will not pay compensation because the risk cover is fire accident and not collapse. The next principle is subrogation. The principle of subrogation states that once the insurer has given indemnity or compensation for a loss, the insurance company can take over the property insured and the rights relating to it. For example, if Mr. Ayo's car had an accident and he has been compensated for it, the insurance company can take over the scrap of that car and sell it. The car no longer belongs to Mr. Ayo, but it now belongs to the insurance company. The next is abandonment. This principle states that a property can be abandoned if the cost of repairing it is more than the actual value, or if its actual loss is unavoidable. For example, if a car is involved in an accident and the cost of repairing that car is more than the value of getting a new one, it is better to get a new one. In this case, the old car will be abandoned. Next is the principle of indemnity. This principle states that the insured should be indemnified to the limit of the amount covered by the policy. It provides that the insured should be adequately compensated. Indemnity means compensation. So the compensation that will be given to the insured in case of loss will be equal to the value of the policy acquired from the insurance company. And lastly, we'll be looking at utmost good faith, or uberrime fide in Latin. This principle states that all relevant information about the property or object must be disclosed to the insurance company. This will help the insurance company to determine whether to cover the risks or not.
Now let's take a quick exercise. Question 1. Define insurance. Question 2. What is meant by the term insurable risk? Question 3. Explain any 4 circumstances when an insured may not be indemnified. Question 4. Write short note on the following. A. Marine insurance. B. Accident insurance. C. Group insurance. And D. Fire insurance. E. Life insurance. Lastly, differentiate between insurable and non-insurable risks. Good luck.
With this, we've come to the end of this class. Thank you for watching. In our next class, we'll be discussing types of insurance. See you there.